Chapter 1. Why multifamily homes for wealth creation? I was recently speaking with a client who wanted to purchase their first home. Many of her close friends had also been purchasing investment homes, and that was a goal she wanted to accomplish as well. The problem was that she didn't have enough funds to purchase a home for herself and investment property. How would you like to have both? One of the most overlooked yet powerful opportunities available in today's real estate market is purchasing a multifamily home. Before we go into more detail, you need to understand what we mean when we say a multifamily property. We are speaking about a 1 to 4 unit property, each with separate entrances. A property that also has the proper zoning for this type of use. Properties that have 5 units and above are classified as commercial properties and will not be part of this discussion since they have different qualifying parameters and down payment requirements. A duplex is a 2-unit property. A triplex is a 3-unit property. A quad or fourplex is a 4-unit property. Purchasing a multifamily home and living in one of the units allows you to have an investment and primary home. But it's much better than that, as you will soon learn in the rest of this book. Here are some of the other benefits. 1. You may have additional tax benefits on the units you are renting. 2. The rents on the other units may cover your entire mortgage payment and may even provide you with a profit each month. 3. These properties generally have less competition when they are placed for sale. Truthfully, I could go on and on about the benefits of owning your multifamily home. My goal with this book is to give you the knowledge and strategies to use to purchase these gems. Many loan officers and real estate agents are not up to date on these properties. Once you've completed this book, you will be armed with the knowledge you need to purchase your very own multifamily home. Often, these homes provide families with what I call generational wealth and can provide income for many years to come. I congratulate you on investing in your knowledge and am thrilled for the journey you are about to embark on. Brian Sachs, National Mortgage Expert, NMLS 225050. Chapter 2. The pros and cons of owning a multifamily home. Owning a multifamily home can create generational wealth for many Americans. In this chapter, we will discuss both the benefits of owning a multifamily home, as well as some of the downsides you should be aware of. Let's start with the benefits. You will have others paying your mortgage payment. As the owner of a multifamily home, your tenants may be enough rent to cover your mortgage payment with some money left over for you. Let's say you have a 4-unit property with a mortgage payment of $2,100 a month. You are living in one of the units. Unit 2 rents for $900 a month. Unit 3 rents for $1,100 a month. And Unit 4 rents for $1,300 a month, for a total of $3,300 a month. That means your tenants' payments not only cover your mortgage payment of $2,100 a month, which means you are living for free, it gets even better, since you now have an additional $1,200 a month left over after your payment is made to spend any way you like. You may be able to qualify for a nicer home in a better neighborhood. The rental income you receive from your tenants can also be used to qualify you as income for your mortgage. Many clients can use this additional income to qualify for a large mortgage, which allows them to look in a better neighborhood than they would ordinarily qualify for. You may have tax benefits, so you pay fewer income taxes. While no accounting advice or tax law advice is being given here, you should check with your tax preparer about the tax benefits of owning a portion of your property that you are renting. These tax benefits, like depreciation and other benefits, may allow you to lower your state and federal income tax bill, allowing you to keep more of your paychecks than you do currently. This truly is one of the big benefits of owning your multifamily home. You are growing your wealth with equity that is created. While you are getting tax benefits and lowering your tax bill while having others pay your mortgage payment, the good news doesn't stop there. Every time you make a mortgage payment, the balance you owe goes down. Generally, real estate prices go up over time, and that difference between what you owe and the value of your home is called your equity. Keep in mind that it is your tenants who are making payments for you, while your mortgage balance is going down and the value of your property is going up. As an example, if your property is worth what it would sell for, $350,000, and your mortgage payoff is $230,000, you would have $120,000 in equity. It can create an additional income source and be the perfect solution for many looking to retire. Many Americans, especially seniors, often live on a fixed income and struggle. Owning a multifamily may allow you to have an extra income from the rental incomes you receive, and of course, have others make your mortgage payment as well, as we explained in the previous example. It may be better than owning 4 single-family homes. Many real estate investors often start with single-family homes. But think about how owning a multifamily building is the better way to become a real estate investor. Let's compare a 4-unit multifamily home where you live in one of the units to 3 single-family homes. Your 4-unit property has 1 roof versus 4 separate roofs on 4 single-family homes. Your 4-unit property has 1 heating and cooling system versus 4 separate heating and cooling systems in your 4 single-family homes. If one of the 4 rental units is vacant, you are only 25% vacant. But when your single-family rental home is vacant, you are 100% vacant. When you go to collect your rents, you can stay in the same building you live in versus visiting 3 separate rental homes. A side benefit is that you will get to see how your tenants are maintaining their units, since you live there as well. When your unit is vacant, you don't have to leave your home to show that unit to prospective new tenants. If you own 3 single-family homes, you will have to go to that property and wait for your prospective tenants to show up so you can show them the home. The possible downsides. You now have others living in the same building. Yes, there will be others living in your building. However, if you currently live in an apartment, it won't be vastly different than your current situation. Each tenant will have a separate entrance to their unit and private access to their mailbox, just like an apartment building you may live in currently. You are now a landlord and must collect rent and make repairs. As a landlord, you are responsible for the repairs for your tenants. This is a great time to make a list of contractors and handymen or women you can use if the need arises. Generally, you will need a plumber, electrician, painters, or a general contractor who can handle all of these areas. It's also a good idea to set aside 10 to 15% of your monthly rental income in an account for repairs, maintenance, and updates. This would be true whether you own a multifamily or just a single-family home. You must make sure you keep up with zoning and permits. When you are purchasing a multifamily home, you and your agent must check with your local zoning department to make sure that the property is zoned correctly for its current use. There have been cases of owners taking a single-family home and putting in a separate unit in the basement. However, it is not properly zoned for that additional unit. It is not legal to operate it that way. A quick call to your local zoning department can tell you exactly the correct uses for the property. Keep in mind that you are also now a landlord to the tenants living in the other units in the property. There are local laws that may require permits and/or other inspections. Your local jurisdiction will also have laws related to the terms of your lease, the amount of security deposit and how it is to be held, and laws related to leasing renewals and evictions. Make sure you are up to date on all of these laws by checking with a local real estate attorney or a REIA. You can find a list of real estate investor associates in the U.S. at nationalreia.org/find-a-reia. As you can see, the benefits and pros may be much stronger than the downsides and cons, but you must make this decision for yourself and your family. Chapter 3. The step-by-step process to owning your own multifamily home. Let me ask you a silly question, okay? Would you give me $1,000 if I promised never to give it back to you? Huh? Yes, I know that sounds like a crazy question, but that is exactly what can happen to you if you don't follow the proper process for purchasing a home. Most people think the first step is going online and looking for a home and a realtor, but that is not the first step. The first step needs to be speaking with a lender and determining what price ranges and programs are you eligible for. What is the maximum monthly mortgage payment you would be approved for? What is the required down payment? What are the pros and cons of the program? You can go to our resource section and schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatteloophole.com. The most important question of all is, what are you comfortable with as your monthly payment and the amounts you want to use to purchase a home? This is the information an agent will need to make sure they are showing you the proper neighborhoods and types of homes. Please keep in mind that with a multifamily home, you will now also have rental income that will hopefully make your payment much more comfortable and allow you to qualify for a nicer home in a better neighborhood. Let's get back to my silly question for a minute. Would you give me $1,000 if I promised never to give it back to you? If you don't take the steps I just outlined of getting pre-approved and instead decide to just go out and look for homes, you very well could lose $1,000. You may have heard horror stories just like that scenario. When you purchase a home, you will generally want to have a home inspection, radon, and pest inspection performed. The lender will also need to perform an appraisal to determine the value and condition of the home. These inspections will generally cost around $1,000, and those are funds that are spent whether your loan is approved or not approved. If you want to schedule a free, no-obligation consultation to see what your financing options would be, please visit resources.therealestatteloophole.com. So now that we know that the first step is to get with the lender and become pre-approved, you can see the other steps in the home purchasing timeline at resources.therealestatteloophole.com. The mortgage process. At this point, you have already completed step 1, and once you have your new home under contract with the seller, you will go through steps 2 through 6. Generally, you can settle 30 to 45 days from step 2 to step 6, but it will depend on the program you've chosen, as well as the lender you've chosen to work with. You can see steps 1 through 6 at resources.therealestatteloophole.com. One last comment before we move on. I am a big believer in not providing a pre-approval letter to buyers before they have selected a home. A pre-approval will tell you, your agent, and the seller the amount you're approved for and the type of financing you will be using. The only people at this point that need to know the program and maximum loan type and sales price are you and your real estate agent. Have you ever played poker or watched a poker game? The players all keep their cards hidden from their opponent, right? This is the same issue when it comes to negotiating for a property. Your offer, in order to be seriously considered, must come with a lender pre-approval letter. The sellers will want to make sure that the buyer putting in an offer can actually get approved and close on the home, or they will have wasted valuable time. If your deal falls through, they will have to list the home over again and wait for the new buyers to get a mortgage. But the seller does not need to know how much you are approved for. The seller does not need to know how much you are approved for. They only need to know that you are pre-approved for the amount of your offer price. A good lender will customize your pre-approval letter for the property and offer price on the home you want to purchase. Let me give you an example. You find a property listed for sale for $299,000. The home is beautiful and is exactly what you were looking for. But after discussions with your agent, you feel that it's a bit overpriced and your offer should be $290,000. You write up the offer and present a pre-approval letter showing you are pre-approved for $350,000. The seller will look at your letter, and that is pretty much the end of the negotiation, right? That's why we would instead only provide you with a letter for that specific property and that offer price at $290,000. The seller does not need to know that you qualify for $350,000, and telling this to the seller hurts your negotiation. Items needed for pre-approval. Here's a list of items most lenders will require for pre-approval. 1. Last 2 years W-2s. If self-employed, last 2 years business and personal tax returns, all schedules, and a year-to-date unaudited profit and loss statement and balance sheet. 2. Last 2 pay stubs. 3. Last 2 months bank statements, all pages, for checking, savings, investments, and retirement. 4. Copy of your driver's license or other photo ID. 5. Copy of your divorce decree or separation agreement, child support order, if applicable. 6. Permission to run your credit report. 7. If you are purchasing a multifamily unit, you will also want to make sure it is zoned properly and the market rent for the rental units. Chapter 4. The funds needed to purchase your multifamily home. When you are considering purchasing a multifamily home, or any home, you will need funds for down payment and for closing costs. The amount of your down payment will be covered soon as we go into the various programs and their requirements. In this chapter, let's take a few minutes to go over the various closing costs and forms you will be presented so you have a clear picture of the funds you will need. The closing disclosure. The following documents are reproduced from the CFPB Home Loan Booklet you can view at consumerfinance.gov. Understand and use your closing disclosure and loan estimate. These forms have been revised and were called the HUD-1, or settlement sheet, and the good faith statement. The loan estimate is given as part of your application, and the closing disclosure must be made available to you 3 days before you close on your mortgage loan. You've chosen a home you want to buy, and your offer has been accepted. You've also applied for and been approved for a mortgage. Now, you are ready to take legal possession of the home and promise to repay your loan. At least 3 days before your closing, you should get your official closing disclosure, which is a 5-page document that gives you more details about your loan, its key terms, and how much you are paying in fees and other costs to get your mortgage and buy your home. Many of the costs you pay at closing are set by the decisions you made when you were shopping for a mortgage. Charges shown under services you can shop for may increase at closing, but generally by no more than 10% of the costs listed on your final loan estimate. The closing disclosure breaks down your closing costs into 2 big categories. Loan terms. Review your monthly payment. Part of it goes to repay what you borrowed and may build equity in your new home, and part of it goes to pay interest, which doesn't build equity. Equity is the current market value of your home minus the amount you still owe on your mortgage. Costs at closing. Be prepared to bring the full cash-to-close amount with you to your closing. This amount includes your down payment and closing costs. The closing costs are itemized on the following pages. On page 2 of 5, total loan costs. Origination charges are fees your lender charges to make your loan. Some closing costs are fees paid to the providers selected by your lender. Some are fees you pay to providers you chose on your own. Prepaids. Homeowners insurance is often paid in advance for the first full year. Also, some taxes and other fees. Visit the resources page for a copy of the HUD pamphlet. resources.therealestatelyoophole.com. Chapter 5. Some creative ways to get the funds you need to purchase your multifamily home. One of the biggest challenges that have kept buyers from purchasing their own is the amount of funds needed for down payment and closing costs. In upcoming chapters, we will cover the FHA, VA, conventional loans, and the down payment requirements in more detail. But here's a quick overview. VA loans require 0 down payment for eligible veterans and qualified reservists. FHA loans, insured by the Federal Housing Administration, require 3.5% down payment. Conventional, often referred to as Fannie Mae or Freddie Mac loans, these loans require 15% for a 2-unit and 25% for 3 to 4 units. Keep in mind that in addition to the down payment requirements, you will also need to have funds for closing costs. Here are some creative ways to consider coming up with the funds needed. Gifts from a family member. You never know unless you ask, and often family members are happy, when able to, assist you with this new investment. Seller credit. Your agent can negotiate having the seller assist you with closing costs. There may be restrictions on how much the seller can assist based on the program you are applying for. Keep in mind that the amount of closing cost assistance you are asking for directly affects the amount of your offer. As an example, if a home is listed for $300,000 and you are asking for $10,000 in closing costs assistance, the seller will view your offer as $290,000, $300,000 minus $10,000. Lender credit. Bet you didn't know that the lender can also assist you with a credit toward your closing costs. The amount of the credit will depend on your loan size, credit profile, and other factors. But it's an often overlooked source of funds you may access to purchase your multifamily home. Selling your collections or other valuables. When I was a kid, I collected sports trading cards and comics. My dad collected stamps and coins. My son, believe it or not, has quite an extensive rock collection. Don't laugh. Some of them are worth $400 to $500 each. If you have a card, stamp, coin, rock, or even a Beanie Baby collection, it might be worth considering them to start your real estate wealth creation journey. Before we end this section, don't forget any old vehicles or bikes that might also have some value. In all of these cases, make sure you are documenting the value of the items and the transaction with a bill of sale and proof of payment. Savings bonds and stocks. Do you have any U.S. savings bonds or stock certificates laying around? Use these funds to start your real estate journey, and there's a good chance it will provide a better overall return than the stocks or bonds might. Cash value in a life insurance policy. Do you have life insurance? If you do, it may be a policy that has a cash value in it that has been building up over time. Check with your insurance agent to determine if your policy has a cash value and how you can go about accessing it. Also, ask how it impacts the amount of life insurance that would be paid in the event of your death, so you can ensure you have sufficient coverage. 401k or other retirement account loans. Do you know who the best person you could borrow money from is? If you said you, then you are correct. Many Americans have 401k and other retirement-like accounts. These accounts will often allow you to borrow money that must be paid back. The beauty of this scenario is that you are paying it back to yourself. You can also take a withdrawal from your retirement account, but you will need to check with your accountant or tax preparer so you are prepared to pay any taxes or penalties. Chapter 6. What to do if you have less than perfect credit. Not knowing your credit score. The good old days of telling a lender you have good credit or have had credit challenges are gone. Lenders now base their decisions on your credit score. There are 3 major credit repositories in the United States: Experian, TransUnion, and Equifax. It's important to point out that not every creditor will report to every credit repository. In addition, each credit repository has its own credit scoring model. The most commonly used models are the FICO score and Beacon score. These scores range from 350 on the low end to 850 being a perfect score. Your eligibility for a particular mortgage program will be based on your credit score. Generally, the FHA and VA programs are more liberal with consumers who have lower scores or have had a past credit challenge. Many consumers will go online to sites that provide a score, or even have a service that provides a score each month. These scores are often not calculated the same way when you are trying to obtain a mortgage. The safest way to know your score is to call the lender you want to work with and have them pull your credit report and scores. Lenders will generally use the middle of your 3 scores to determine the score to be used when qualifying for a mortgage loan. Most lenders will not charge you for this report, and running your credit report does not create an obligation for you to use that particular lender. Important. Generally, when a mortgage lender checks your credit report, it will not adversely affect your score. This is a common myth, so be careful. In fact, If you have multiple mortgage companies check your credit within a limited window, the credit bureaus will treat it as one pull. While we are on the subject of credit, let me state very, very clearly. You do not need to have perfect credit to obtain a mortgage. In fact, we regularly assist clients who have had a bankruptcy, foreclosure, or other challenge get into a home with very low down payments and very attractive interest rates. You may be wondering what happens if we can't help you right away. In that case, we are able to refer you to professional partners we work closely with who will assist you with getting your situation back under control. One of the fastest ways to get your credit scores up is by paying down the amount you owe on revolving credit card accounts. This is called your usage ratio, and it is a very important part of your credit score. For example, if you have a credit card with a $1,000 credit limit, you may have always paid it on time, but if your balance is over $250 or $300, it can hurt your credit scores. Other items that impact your credit scores are the types of credit you have, the age of your accounts, and also your payment history. Why is the score you just ran different than the one I'm seeing online? Is a question I'm often asked by clients. The reason for these different scores is that there are 3 different scoring models, depending on the type of credit you are applying for. Credit card, installment debts like a car or credit union loan, and mortgage applications. Doesn't a lender checking my credit affect my score? This is a question I'm often asked by concerned clients. The answer is that mortgage inquiries have little to no effect on your scores. In fact, if you go to several mortgage lenders within a 30 to 40-day window, the credit bureaus will acknowledge them as just one pull. To be clear though, when you apply for credit cards and other personal installment debts, the inquiries can lower your credit scores. Want to see what your credit score is and learn more about the best ways to raise your scores? Visit resources.therealestatelyoophole.com. Chapter 7. How to buy your multifamily home with zero down payment. Unlike all the late-night commercials on buying homes with zero down, there is one program that does allow qualified buyers to actually do exactly that. You may be eligible for a VA loan by meeting one or more of the following requirements. You have served 90 consecutive days of active service during wartime. You have served 181 days of active service during peacetime. You have 6 years of service in the National Guard or Reserves. VA loan eligibility for surviving spouses. Many surviving spouses of deceased veterans have used the Home Loan Guarantee Program to purchase property. The VA's policy is that these surviving spouses are permitted to use their deceased spouse's entitlement in the Home Loan Program. While most benefits veterans receive are one-time occurrences, the VA allows veterans to use their home eligibility as many times as they like, as long as they have sufficient entitlement left over. That means you can purchase a home using your VA benefits, and if you sell or pay off that home, your entitlement can be 100% reinstated for you to use again. The program is available for qualified veterans and a veteran and spouse only. Children of veterans are not able to use their parents' eligibility. The benefits of a VA loan. The Veterans Home Loan Program allows qualified veterans to purchase a 1 to 4 unit dwelling with no money down, as long as they will be living in one of the units. In addition, the Veterans Administration will allow the seller to pay all of the buyer's closing costs. Now stop for a second and think about this. If you are a qualified veteran, you can purchase a 4-unit dwelling with no money out of pocket. That is truly the least we can do as Americans to thank and assist those who have so bravely served our great country. It truly tears my heart to see so many veterans struggling financially when they could be living rent-free with no out-of-pocket cash and be receiving monthly income checks from their tenants. VA loan qualifications. The Veterans Home Loan Program allows veterans to use 75% of the rental income on the units that are occupied by tenants as income to qualify for your mortgage. Many veterans are now able to afford a nicer home in a more expensive neighborhood that they may not have considered prior, but can now easily qualify for and afford by using the income from the other 1, 2, or 3 units in the property. How much of a VA loan can a veteran qualify for? VA uses two different methods to determine the maximum loan a veteran qualifies for a loan. Method 1. Ratio, or debt to income method. Veterans can qualify for a VA home loan provided their debt to income ratio meets VA and lender standards. Although the debt to income ratio, or DTI ratio, is an important part of your financial history that VA loan lenders examine, it's only one of several VA loan qualifications, and it's important to note that sometimes these standards may also vary from lender to lender. What does debt to income ratio mean? Simply put, a borrower's DTI, debt to income ratio, measures the borrower's monthly debt against his or her gross monthly income. It's expected and common to have some debt. Only one DTI ratio matters to VA loan lenders, and it includes monthly debts such as housing costs, recurring debts, and other outstanding payments. What's a good debt to income ratio? The VA's benchmark is 41%, but VA loan lenders are not bound to that standard. Therefore, military borrowers will likely find different DTI ratio standards with different lenders. This ratio is a decent measure of financial health, so lenders aren't keen on doling out loans to borrowers with overwhelming debts. If your DTI is not below that 41% marker, don't get concerned just yet. That will not automatically disqualify you for a VA loan, although it will require you to have additional residual income, which is another VA requirement. Other parts of your financial history influence lenders' ultimate decision. That's why it's important to also monitor and maintain a healthy credit score. We have personally approved many veterans with a ratio in the 50 to 52% range that had good residual income and other good compensating factors. Take a look at this example of how income, debts, and ratios are calculated. You earn a salary of $48,000. So, divide that by 12 to find your gross monthly income, $4,000. Debts include your $250 payment for an auto loan, $850 on your new mortgage, and $300 on other debts, credit cards, lines of credit, etc. Your total debts for the month equal $1,400. Divide the $1,400 in debts by your $4,000 gross monthly income for a back-end DTI ratio of 35%, which is well below the standard 41% stated VA ratio. The debt-to-income calculation allows the lender to determine the veteran's ability to repay the mortgage without allowing them to get in over their head. A ballooning DTI ratio likely indicates to VA loan lenders that a borrower needs to exercise more financial control. However, not all income is counted equally. What incomes and debts do VA loan lenders use for DTI ratios? Examples of incomes pre-taxed: Social Security, VA disability, retirement, SSI if long-term, earned income, tips, commissions, overtime, and bonuses. Rental property income. Keep in mind that when you are buying a multifamily home, 75% of the market rents from those units can also be counted towards your income, which allows you to buy a nicer home in a nicer neighborhood. Residual income from investments. Child support and/or alimony. These must continue for 3 years after settlement. Examples of debts: mortgage payments, current and new, auto payments, credit card minimum payments, student loan payments, co-signed credits, child support and/or alimony. Debt totals do not usually include insurance, utility, or other normal household expenses, but also notice that not all forms of income are considered either. Income from commissions and self-employment earnings may require proof of 2 years of history, and then only the average of the net income is counted. So, if my DTI ratio is high, can I still get a VA loan? As I mentioned earlier, if your debt-to-income ratio is over 41%, it is still very possible to obtain a VA loan. So let's discuss method number 2 VA uses in determining the maximum loan a veteran will be approved for. Method number 2. Residual method. In addition to DTI, one concept that's unique to VA and some FHA loans is the idea of residual income qualification. What is residual income? Residual income is sometimes confused with DTI. However, the Department of Veterans Affairs also wants to make certain that you have enough money left over to take care of your day-to-day expenses. In order to qualify for a VA loan, you must meet a specific residual income threshold, which varies depending on the size of your family and where you live. How do you calculate residual income? Residual income is simply what's left over after all your expenses are paid. To calculate the number, you simply subtract all the bills mentioned above that make up your DTI ratio. The VA's minimum residual income is considered a guide and should not trigger an approval or rejection of a VA loan on its own. Instead, it's most often considered in conjunction with other credit factors. The DTI ratio and residual income are decidedly different, but they have an effect on each other. VA also requires less residual income for borrowers with loan amounts below $80,000. At resources.therealestatelyoophole.com, you can find the VA's residual income tables by region. While it's possible to qualify with a DTI ratio that's more than 41%, you must exceed the regional residual income requirement by at least 20%. So if you have a family of 4 and you live in Michigan, your regional residual requirement is $1,003. If your DTI ratio is 43%, you now must have a residual income of $1,203 to be approved for a VA loan. Understanding the DTI ratio and residual income balance can be difficult. That's why it's so very important to work with a mortgage lender who is experienced in dealing with VA loans. One of our home loan experts would be happy to explain the details that reflect your unique financial situation and help you make any necessary adjustments in your budget so that you may qualify for a VA loan. You can go to our resource section and schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatelyoophole.com. VA funding fees. While you don't have to worry about private mortgage insurance, you do have to pay a VA funding fee. The VA funding fee is a one-time payment that the veteran, service member, or survivor pays on a VA-backed or VA-direct home loan. This fee helps to lower the cost of the loan for U.S. taxpayers, since the VA home loan program doesn't require down payments or monthly mortgage insurance. Your VA funding fee depends on the size of your VA loan down payment and whether it's your first-time use of the benefit. The funding fee can and generally is included in your loan amount and is not an expense that has to be paid at settlement. As an example, if you are purchasing a home for the first time at a cost of $200,000, your loan would be $200,000 plus 2.3%, $4,600, for a total loan of $204,600. There are some veterans who may be exempt from paying the VA funding fee. VA funding fee exemptions. Not all veterans have to pay funding fees for VA loans. For instance, a disabled veteran who is receiving compensation from the VA for a service-connected disability is exempt. Note, the key is service-related disability. Here's a complete list of funding fee exempt applicants as follows. Veteran receiving VA compensation for a service-connected disability. Veteran entitled to receive VA compensation for a service-connected disability, but receives retirement pay or active service pay. Surviving spouse of a veteran who died in active service or from a service-connected disability. Service member on active duty who provides on or before date of loan closing evidence of having been awarded the Purple Heart. Exempt status will most likely be confirmed on the veteran's Certificate of Eligibility, COE, a document the lender requests from VA to prove the veteran is eligible for a VA loan. Items needed for pre-approval. Last 2 years' W-2s, if self-employed, last 2 years' tax, business, and personal tax returns, year-to-date profit and loss statement and balance sheet, last 2 pay stubs, last 2 bank statements, checking, savings, investment, and retirement, copy of your DD 214, copy of your COE, Certificate of Eligibility, available at va.gov, copy of your driver's license or valid photo ID, permission to run your credit report. If you are receiving VA-related disability or pension, provided documentation of the annual amount you are due. You can go to our resource section and schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatelyoophole.com. Case study. Joe and Sarah came to me to inquire about a VA loan. They were in their late 50s and were nearing retirement age. But like most Americans, they had not saved nearly enough money to create the retirement lifestyle they had dreamed of. They had lived in the same home for over 30 years that they had purchased using Joe's VA entitlement. The mortgage was paid off, but they had taken out a home equity loan to put their 2 daughters through college, so they had very little equity left. During our discussions, Joe mentioned that he had always wanted to invest in real estate, but had never felt like he could, since, like most Americans, he was working as hard as he could just to keep his bills paid and food on the table. During our conversation, I mentioned the real estate loophole. I mentioned to them that they could buy a 2, 3, or 4 unit home and put nothing down using his VA entitlement. They could use the income from the other units to pay their own mortgage payment and probably have some money left over they could live on. Plus, as the mortgage got paid down, they would be enjoying a tax break for the leased units and leaving a financial legacy for their 2 daughters to enjoy and benefit from. Joe and Sarah find a home. Joe and Sarah found a beautiful 4-unit home that was in a neighborhood they had never considered looking at, since the homes they thought was above their budget and comfort levels. They purchased this 4-unit property that had 3 2-bedroom units and 1 3-bedroom unit that they decided to move into. Their mortgage payment included taxes and insurance are $1,500 a month. But let's check out their income for a minute. The 3 2-bedroom units each rent for $1,100 a month. $1,100 times 3 is $3,300 in income, minus their mortgage payment of $1,500. Joe and Sarah are now able to pay their mortgage from the rental income, enjoy a tax break on the 3 rental units, and still have $1,800 a month left over before any expenses. A truly win-win situation for Joe and Sarah. Chapter 8. How to buy your multifamily home with only 3.5% down payment. If you have thought owning a home or purchasing an investment property is out of your reach due to the large down payments required, you will love this chapter. The FHA, Federal Housing Administration, which is a part of the Department of Housing and Urban Development, has a program just for you. FHA will allow a borrower to purchase a property with up to 4 units, as long as they will be occupying one of the residences as their primary home. The benefits of the FHA program are 1. Down payment of only 3.5% of the purchase price is required. 2. The seller is allowed to pay up to 6% of the purchase price towards the buyer's closing costs, but this is all part of your contract negotiation. Qualifying for an FHA loan. Qualifying for an FHA loan is generally considered to be easier than a standard conventional loan. FHA credit standards are also a bit easier than standard conventional financing, and generally scores in the 620 range are acceptable. Some lenders may, however, be able to approve you with lower scores, like 580, while others may require slightly higher scores in the 640 and above range. The FHA program will look at a borrower's eligible income and allow 41% of that monthly income to be for a mortgage payment, plus minimum payment on monthly debts. These debts may include child support, alimony, school loans, credit card debts, and other installment debts like car or personal loans. While 41% is the standard FHA guideline, that figure can often be exceeded depending on the borrower's total profile, and we have often been able to get loans with a 50% ratio approved and settled when the borrower had good credit scores, stable job income, and assets left over after settlement. Big benefit. Keep in mind that if you are buying a multifamily home with the FHA program, they will allow 75% of the market rent from each unit to be counted as additional income, which allows you to buy a nicer home in a nicer area than you might qualify for on a single family home. FHA mortgage insurance. Since borrowers are able to put down only 3.5%, the FHA does have what is known as mortgage insurance. This insurance protects the lender in the event the borrower is unable to pay and is foreclosed on. There are two insurances that FHA charges. The first is known as the upfront mortgage insurance and is a percentage of your loan. This amount is generally financed right into your mortgage amount. The second insurance is a monthly percentage of your loan and is part of your monthly mortgage payment. Unlike a conventional loan, these mortgage insurance amounts do not go away once you have 80% equity, but the program does allow buyers who might otherwise not qualify become homeowners and create generational wealth. FHA loan limits. FHA loan limits range from $331,760 to $765,600 and vary by county. The maximum amount for an FHA loan on a single-family home in a low-cost county is $331,760, while the upper limit in high-cost counties is $765,600. These loan limits can change annually, so it's always best to check this link to see the current loan limits for the city or county you are purchasing in. entp.hudapp/idapp/html/hi-costlook.cfm. One of the final benefits of the FHA program allows you to purchase a home that may be offered below current market values and in need of renovation. We will discuss in greater detail in an upcoming chapter. Case study number 1. James thought he could not afford that neighborhood. James, a 27-year-old professional, came to me because he was tired of paying rent and wanted to start building wealth through real estate. Since James was just starting out, his earnings were not enough to qualify him for the neighborhood he wanted to live in. To complicate matters, he had taken out school loans to pursue his master's degree. I suggested getting a cosigner, but James wanted to do this on his own. We could not change his income and debts. Or could we? Most loan officers would have stopped at this point and told James to either pay down his debts, he could not, or just purchase a home he may not like in an area he was qualified for. Instead, I told James about the FHA multifamily option. He was very excited and immediately identified a beautiful and well-maintained 3-unit property in the exact location he was searching for. This property has big, spacious units and a big, beautiful yard with trees and flowers. Unit 1 was a big 2-bedroom unit that rented for $1,200 a month. Unit 2 was another big 2-bedroom and den that rented for $1,400 a month. Unit 3 was downstairs and had 2 bedrooms and a den. James took this unit for himself. We were able to count 75% of the rent on Units 1 and 2 for a total of $1,950 per month. $1,400 plus $1,200 equals $2,600 times 75%. $1,950 in additional income, which was enough to allow James to be in the neighborhood he wanted to be in. But it gets even better. James's mortgage payment on this property is $1,820 a month. Assuming both units are rented for $2,600, James is now able to have his tenants making the mortgage payment and still has $780 in positive cash flow before expenses left over. All of this while James pays down the mortgage. The property goes up in value, and he enjoys the tax benefits of the investment portion of this home he can now write off. Case study. They wanted to own a home and invest, but thought they couldn't do both. Bob and Joan, a couple in their mid-40s, had always dreamed of owning their own home instead of renting. They were also avid fans of all the property flipping and investing shows on HGTV, and dreamt of becoming a landlord to build their wealth for their retirement years. But they did not have enough money saved to buy a home and an investment property. Bob and Joan worked very hard to save their money for a down payment and closing costs, but something always came up. Sick relatives that required travel, broken cars, unexpected layoffs, and expenses for their kids. When they called me, they were truly motivated and hopeful we could find a way for them to finally become homeowners and also provide a legacy for their children. I explained to Bob and Joan the way they could own a home with only 3.5% down and also have investment income from renters, all in one loan and one property. Bob and Joan found a great 4-unit property with each unit being a 3-bedroom, which is very unusual. The property had once been a mansion that was later rezoned and reconfigured. The property also had a very large lot and backyard, and 3 garages. They are using one of the garages and have rented out the other 2 garages to their tenants for additional monthly income. Their current mortgage payment is $2,100, which is a figure they would have never believed they could comfortably afford. But the better news is that their gross rental income more than covers their mortgage payment, plus what amounts to a great second income. Unit 1 they are living in. Units 2, 3, and 4 each rent for $1,900, producing $5,700 in income. Garage 2 and 3 rent for $200 a month. Total income, $6,100. Less the mortgage payment, $2,100. Profit before expenses, $4,000. That equals $4,800 per year. Did you catch that? Bob and Joan now have their mortgage paid for by their tenants. They have an additional $4,000 a month in income before expenses, assuming their units are fully leased. As a final bonus, they now have additional tax benefits from the 3 units that helps them reduce the taxes they owe each year. Bob and Joan have accomplished their dreams of owning their own home, owning an investment property, and leaving a financial legacy for their children. You can go to our resource section and schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatelyoophole.com. Chapter 9. How to buy your multi-home with a conventional loan. Fannie Mae and Freddie Mac are quasi-government-backed agencies that purchase conventional loans on the secondary market. These loans are often referred to as conventional financing. When purchasing your multifamily home using conventional financing, you will need the following down payments. 1 to 2 units require a 15% down payment. 3 to 4 units require a 25% down payment. Conventional loans generally require mortgage insurance if you are putting down less than 20%. This insurance covers the lender in the event you default and will automatically drop off once you have reached sufficient equity. It should be noted that there are certain programs that will allow you to put down less than 20% and still avoid mortgage insurance. Credit and qualifying standards. Credit and qualifying standards are stricter for conventional loans than FHA or VA loans. You are generally required to have higher credit scores for conventional loans. The good news is that income for the units you are renting can be counted as qualifying income. Generally, 75% of the rental unit's income can be counted to offset your debts. For many clients, this allows you to purchase a more expensive home in a different neighborhood than you had initially considered. Lastly, conventional loans have appraisal standards that are a bit more relaxed than FHA or VA standards, which the seller may view as a plus when considering your offer. Seller contributions. When you are purchasing a multifamily home and living in one of the units, you can negotiate, asking the seller to contribute up to 6% of the purchase price towards your closing costs. Since asking for closing cost assistance can affect the strength of your offer, always make sure that you ask your buyer's agent for guidance first. Chapter 10. How to use the real estate loophole if you are self-employed or currently an investor, and close in the name of your business. There are many potential home buyers and investors who would love to buy a home, but own their own business or work as a contract employee and are not showing sufficient income to qualify for a mortgage. When you are self-employed or a contract employee, there are generally 2 issues that may prevent you from getting a standard mortgage. 1. Most mortgage lenders will require you to have a 2-year history working as a contract employee in the same field. If you own your own company or are self-employed, you will also be required to show a 2-year history. 2. One of the major benefits of being self-employed or a contract employee is the amount of deductions you are able to write off, thereby saving on the amount of taxes you owe. However, mortgage lenders will believe what you have reported on your last 2 years' tax returns. They will use your net income after your expenses, not the actual amount you earned. Many times, this will cause buyers to qualify for a lower amount than they had projected. Sometimes it will disqualify you entirely. I recently had a buyer who was in this exact situation. She owned a construction company for the past 2 years. Year 1, she grossed $139,000 and had $80,000 in expenses. Year 2, she grossed $158,000 and had $90,000 in expenses. Here's the math. Year 1, net $59,000. Year 2, net $68,000. $59,000 plus $68,000 is $127,000. Divided by 24 months is $5,291. That's the amount of monthly income we were able to use to qualify her. I'm sure I don't need to tell you that there is, of course, an entire underground economy of workers who are paid in cash. The solution I'm about to share with you doesn't even ask questions about your income. But before we get there, I have one more important point to share with you. While I am not an attorney and am clearly not giving legal advice, it is advisable many times to own properties or units you may be renting in the name of a legal entity instead of your name personally. You should always check with an attorney and a qualified accountant to make sure you are holding title in a way that protects you and provides the most tax benefits. Most traditional lenders offering conventional, FHA or VA financing will require you to hold title to the property in your own name personally. But remember, we are using the real estate loophole. That means we will be living in one unit and renting out the other units, which means we will have tenants living on our property. You will want to speak with the professionals and potentially put your property in the name of an entity you own instead of your name personally. This can add an additional layer of legal protections and also provide some potentially large income tax savings on the units you are renting. The solution? A no-income verification investor loan. There are now a number of programs for seasoned investors or property managers that do not ask any questions related to your income. You will generally have to put 10 to 20% down, but the good news is that you don't need perfect credit to qualify for these programs. Generally, scores in the 620 and above range are acceptable. Yes, they generally have a slightly higher interest rate, but that should not affect your decision to purchase. You must look at these opportunities without emotion, and remember that getting a mortgage is not a life sentence. You can always refinance down the road, or even pay that mortgage off early by prepaying the mortgage with the extra income from the units you are now renting. If you are a 1099 or self-employed buyer with a 2-year history, you can potentially use a similar program to purchase up to a 4-unit property with only 10% down. Once again, you would not need to have perfect credit, but you will need to live in one of the units as your primary home. You can go to our resource section and schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatelyoophole.com. Chapter 11. 5 Common Mistakes to Avoid When Purchasing a Home. Mistake number 1. Not all real estate agents are the same. Are there different types of agents, and which is best? It's a beautiful Sunday afternoon, and you are out driving around dreaming of finding the perfect home. Suddenly, you find yourself in a neighborhood that looks really nice. You continue driving around and notice an open house and some balloons. So, of course, you stop and go in. The agent in the home is very nice and shows you around. She asks you some questions and answers all of your questions about the home. It seems that she is very knowledgeable, and you start to feel like you trust her. After some additional questions and answers, she asks you if you are interested in the home, and you tell her you are. The home is listed for sale at $290,000, and you tell her that you think that is a fair price, but would like to put in an offer at $275,000, and would be willing to go up to the $290,000 price if you need to. You have just made a major error. There are generally 3 types of real estate agents in terms of representation. Listing agent. The listing agent is the agent that represents the seller in the transaction. Their legal obligation is to protect the seller's interest. Their goal is to sell the home as quickly as possible and for the highest price possible. Selling agent. The buyer's agent works exclusively for the buyer to protect their interests. They will try to negotiate the best price and terms for the buyer. The beauty of working with a buyer's agent is that it often will not cost the buyer any additional funds, since generally the seller pays the commission on the sale of the home exclusively. Dual agent. Dual agency means that one agent represents both the seller and the buyer in the same real estate transaction. A dual agent must walk a narrow tightrope to be neutral toward both parties, and they may not disclose confidential information to either party. At best, they say dual agents can't fulfill their fiduciary obligations to both parties. They can't advance the best interests of both buyer and seller because those interests always diverge. At worst, dual agency creates a harmful conflict of interest. Let's go back to that home you liked to see what happens. Just to recap, you love the home. You've told the agent that you want to offer $275,000, but are willing to raise your offer to the full list price of $290,000 since you don't want to lose it. The agent must now go back to the seller and present your offer. She has a legal fiduciary obligation to tell the seller not to accept your offer at $275,000, since you have said you will go up to the full sales price of $290,000. The moral of this story is to engage the services of a buyer's agent before you begin your home search. This ensures that you have a professional on your side that is protecting your interests in the negotiations. Best of all, as we said before, the seller generally pays both sides of the commission, so there is no reason to go without representation. Mistake number 2. Thinking every mortgage lender is the same. Ever wonder why one mortgage company would give you one answer and another would say something completely different? Why would one lender approve you while another one might say no or not yet? There are 3 types of lenders in the marketplace, and we will explore the pros and cons of each one. Mortgage banker. This company will have a credit line known as a warehouse line and will close your loan with their own funds. The loans are then sold on the secondary market to Fannie Mae, Freddie Mac, or if a government-insured loan like FHA or VA, to Ginnie Mae. These agencies make the guidelines that tell the lender what is and isn't acceptable in terms of credit, income, property, and qualifying ratios. The lender will then collect your monthly payments or will sell their rights to service your loan to a different company. Not to confuse you so early in our report, but there are also 2 different types of mortgage bankers. One type is a company owned by a bank. The other would be an independent mortgage banker. This is important because often the bank-owned mortgage bankers have additional guidelines they create in addition to the standards set by Fannie Mae, Freddie Mac, FHA, or VA. These guidelines are meant to add an additional layer of protection for these institutions in the event a borrower defaults on the loan. The other important distinction is that consumers who bank with a bank are under the mistaken impression that they might receive preferential treatment since they have an account at a particular bank, when in reality, the bank has a mortgage subsidiary and could actually be more conservative than an independent company. Mortgage broker. A mortgage broker rarely has their own funds. They will take your application and place it with a mortgage banker or private portfolio. Their commission is earned by adding an additional fee to the lender's price. The lender your loan is placed is the one that will ultimately approve or deny your loan, and if approved, will then provide the funds for you to go to settlement. Private or portfolio lender. This often is a small savings and loan or a private person or company. A portfolio lender is truly lending you their own funds. Since it is their own funds, they are able to make whatever rules and guidelines they feel are an appropriate risk for their investment. Portfolio and private lenders are often used when a borrower is unable to qualify for standard or traditional financing and will often charge above market rates due to the increased risk. Now that you know who might be lending you the funds to purchase a home, let's continue our discussion by clearing up several other important misconceptions. 2. What are points and should you pay them? Why do lenders have different rates for the same programs? Great question, but the answer can tend to be rather long, so let's just discuss a few different reasons here. When you are shopping for a loan, you should always be comparing APR. This figure forces a lender to disclose the fees they are charging on a loan. The APR shows you, the consumer, what a lender is yielding on your loan. You may see two lenders offering 4%, but one has an APR of 4.29 and the other an APR of 4.73. This difference is due to one lender charging you more fees than the other. If you would like a more detailed explanation of these figures and how they are calculated, schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatelyoophole.com, and we would be happy to provide you the answers. What is a point? Points are prepaid interest paid at the time of closing in order to obtain a lower interest rate. As an example, let's say you are shopping for a $200,000 mortgage and one lender offers you 4.25% with no points or origination fees, while the other offers you 4% with 1 point. Note, points are a percentage of your loan amount. On the surface, 4% sounds much better than 4.25%, right? But let's analyze this a little further. Points 4.25, $0 down, $984 in principal and interest. 4%, $2,000 down, $956 in principal and interest. The cash difference is $2,000, and the payment difference is $28. If you chose the 4% with 1 point difference, you would need $2,000 additional dollars at closing, and you would save $28 per month. Is this a good deal? The answer is, it depends. By those figures, we see that you are investing $2,000 up front for the privilege of saving $28 a month on your mortgage payment. If we divide $2,000 by 28, it will take you 72 months, or 6 years, just to break even. Generally, it's advisable to minimize your cash outlay or possibly allocate that extra $2,000 right to your loan balance. Mistake number 3. Not knowing your credit score and not letting your mortgage lender check it. The good old days of telling a lender you have good credit or have had credit challenges are gone. Lenders now base their decisions on your credit score. There are 3 major credit repositories in the United States: Experian, TransUnion, and Equifax. It's important to point out that not every creditor will report to every credit repository. In addition, each credit repository has its own credit scoring model. The most commonly used models are the FICO score and Beacon score. These scores range from 350 on the low end to 850 being a perfect score. Your eligibility for a particular mortgage program will be based on your credit score. Generally, the FHA and VA programs are more liberal with consumers who have lower scores or have had a past credit challenge. Many consumers will go online to sites that provide a score or even have a service provide a score each month. These scores are often not calculated the same way when you are trying to obtain a mortgage. The safest way to know your score is to call the lender you want to work with and have them pull your credit report and scores. Lenders will generally use the middle of your 3 scores to determine the score to be used when qualifying for a mortgage loan. Most lenders will not charge you for this report, and running your credit report does not create an obligation for you to use that particular lender. While we are on the subject of credit, let me state very, very clearly, you do not need to have perfect credit to obtain a mortgage. In fact, we regularly assist clients who have had a bankruptcy, foreclosure, or other challenge get into a home with very low down payments and very attractive interest rates. Let's face it, we are just getting out of an economic meltdown, and many good people went through some very challenging times. In fact, the Department of Housing and Urban Development, FHA, created a back to work program for just this reason. You can learn more at our blog, rentersecrets.com. You may be wondering, what happens if we can't help you right away? In that case, we are able to refer you to professional partners we work closely with who will assist you with getting your situation back under control. Mistake number 4. Pre-approval versus pre-qualified. Which one is better? Grants, funds needed, and comfort levels. Would you ever consider calling a physician, telling him your symptoms, and then scheduling surgery? Yes, I realize that sounds silly, but this happens every day in the mortgage business. A client will call a lender and provide their income, debts, and assets, and ask the lender how much they qualify for. Sometimes consumers will only go online and use a mortgage calculator to see what price range they qualify for. Both of those scenarios are a mistake. Getting pre-qualified simply means that you've spoken to a lender, and based on the information you provided, it appears that you qualify for a particular mortgage amount and program. Pre-approval, on the other hand, is when you actually provide the lender with your last 2 years' income information, have a credit report run, and have provided your asset information via statements. A pre-approval allows you to discuss the various financing options with a lender, and also establish the program that best meets your monthly payment and funds at closing requirements. Often, the lender can recommend various grant programs and also help you better establish the proper price range you should be exploring for a home. Pre-qualifications and pre-approvals. The difference between pre-qualification and pre-approval. Both terms describe a situation where a potential borrower tries to establish the amount of the mortgage loan that the borrower will be able to obtain. Pre-qualification is less formal than pre-approved. The potential borrower seeking to pre-qualify is only asking for a general or approximate estimation of the amount for which the borrower would be eligible. The borrower is not looking for any sort of formal commitment from the lender for a loan of a particular amount. The pre-qualification enables the borrower to start house hunting and look for homes to possibly purchase, where the price is less than or equal to the pre-qualification amount. A pre-approval is a more formal statement by the creditor of how much the creditor will lend to the consumer. In a pre-approval, the creditor commits to an amount that the creditor will lend to the consumer. This is a document the consumer can use in shopping for a house. The consumer can prove that he will have financing at the level shown in the pre-approval. You can remember the difference by keeping in mind that approval has a more specific and definite tone to it. The consumer has been approved. Qualified suggests that while the consumer may meet certain standards, he or she has not yet been approved. How are pre-approvals and pre-qualifications treated under TRID? There are 3 rules in TRID that have an effect on pre-approvals and pre-qualifications. The rule that prohibits imposing fees before delivery of the loan estimate. The rule that prohibits requiring verification information prior to providing the loan estimate. The rule that requires a notice on written information provided to the consumer. The fees rule. This rule prohibits anyone from charging the consumer a fee in connection with the consumer's mortgage loan application prior to the consumer receiving the loan estimate disclosures, and prior to the consumer indicating an intent to proceed with the transaction. One exception is charging a fee for pulling a consumer's credit report. This fee may be charged to the consumer in advance of issuing the loan estimate. If the consumer is requesting a pre-qualification or pre-approval, and the loan would be subject to the TRID rules, don't charge a fee, other than for a credit report, prior to providing the loan estimate. Also, be sure the consumer has indicated an intent to proceed with the transaction before charging any associated application fees. The verification rule. This rule prohibits anyone from requiring the consumer to provide documents verifying information related to their mortgage loan application before providing the loan estimate. If the consumer voluntarily submits verifying information, the creditor is allowed to collect it and take verification action. Also, The creditor can collect any information that it normally requires prior to providing the loan estimate. But neither the creditor nor anyone else can require, before providing the loan estimate, that the consumer provide verifying documentation. You can collect the designated information you require in creating a pre-qualification or pre-approval, but you cannot require the consumer to provide documentation that verifies this information unless you've provided the loan estimate. For example, if you normally require the balance amounts of deposit accounts, you may collect that information, but you cannot require that the consumer provide bank statements to verify the information without having provided the loan estimate. The Written Information Rule. This rule requires that a notice be placed on any written estimate of terms or costs provided to the consumer before the consumer receives the loan estimate. The notice must be clear and conspicuous and appear at the top of the front of the first page of the written estimate. It must be in a font size no less than 12 point and must read as follows. Your accrual rate, payment, and costs could be higher. Get an official loan estimate before choosing a loan. Mistake number 5. Thinking you need a lot of money to buy a home. When you purchase a home, the funds you need to invest are broken down into 2 different areas. You will need a down payment and closing costs. I've provided you with a sample settlement sheet at the end of this report that provides a breakdown of these costs. Down payment. If you qualify for a VA loan, there is no down payment if you have full eligibility. FHA loans generally require a 3.5% down payment, while most conventional loans require a minimum down payment of 5%. Closing costs. In many areas, closing costs average 2 to 5% of your purchase price and covers lender fees, title-related fees, state and local taxes, as well as the creation of an escrow account for your taxes and insurances. But what do you do if you simply don't have enough money? Here's a list of ways I've assisted my clients obtain the funds they need. 1. Gift letter from a relative. 2. State or local grant program. 3. Seller assistance. 4. Assistance. Yes, the lender can assist you with some of the funds for your closing costs, but will often charge a slightly higher rate. 5. Withdraw from a 401k or other retirement account. What others say about Brian Sachs. By now, I hope you have a pretty good idea of the power of the real estate loophole and how it can help you build generational wealth and live comfortably while still enjoying some significant tax benefits and a side income. So, I thought I might share with you some comments from some of the over 5,987 families I've helped over the past 37 years. You took the time to explain what was expected of me as far as documentation. You really helped make the process a lot easier than I expected. The communication between us made me feel very comfortable about the process. W. Kierland, 514. He was thereby via email and phone when I needed to talk with him. He is knowledgeable and assisted me with other resource options for closing costs. Also, he is very easy to talk to, and when I was unable to understand something, he broke it down in simple terms. I am very grateful. Brian assisted me through a very complicated 203k purchase, and although things didn't go as smooth as hoped, Brian and his team were always there pushing things forward. As a panicked buyer getting closer to settlement, Brian would reach out to me just to let me know that he had no news. That may sound silly, but it meant a lot and helped me through the process. I would recommend to work with him and his team. Matt. My husband and I used Brian for our first home purchase. We were extremely happy with the service we received. Brian is very knowledgeable and was able to get us exactly what we wanted. He was very responsive, and the team he works with were just amazing. Excellent service. Mrs. Mr. 906. I highly recommend Brian when it comes to purchasing or refinancing on your new or existing home. Brian was very professional and explained everything in detail to make us completely satisfied and prepared for settlement. Anonymous. We started our house purchase process last year, but were given many reasons why we had to wait. Both of us had changed our jobs and were working less than 2 years in our current roles. Brian's creativity and knowledge worked through all the hurdles that other lenders saw that could prevent us from becoming homeowners. Brian kept us motivated so that we could become homeowners. Pamela E. You can go to our resource section and schedule a free, no-obligation consultation with a licensed loan officer at resources.therealestatelyoophole.com. Chapter 12. Glossary of Terms. Appraiser. One who is trained and educated in the methods of determining the value of property, appraised value. You will pay a fee for an appraisal report containing an opinion as to the value of your property and the reasoning leading to this opinion. Credit report fee. This fee covers the cost of a credit report, which shows your credit history. The lender uses the information in a credit report to assess your credit worthiness. Default. The inability to pay monthly mortgage payments in a timely manner or to otherwise meet the mortgage terms. Delinquency. Failure of a borrower to make timely mortgage payments under a loan agreement. Down payment. The portion of a home's purchase price that is paid in cash and is not part of the mortgage loan. Earnest money deposit. Money you will put down to show that you are serious about purchasing the home. It often becomes part of the down payment if the offer is accepted, is returned if the offer is rejected, or may be forfeited if you do not follow through with the deal. Escrow account. An impound account in which a portion of your monthly mortgage payment is deposited to cover annual charges for homeowners insurance, mortgage insurance if applicable, and property taxes. Escrow agent. A person or entity holding documents and funds in a transfer of real property, acting for both parties pursuant to instructions. Typically, the agent is a person, often an attorney, escrow company, or title company, depending on local practices. Flood certification fee. A fee for the assessment of your property to determine if it is located in a flood-prone area. Foreclosure. A legal process in which mortgaged property is sold to pay the loan of the defaulting borrowers. Loan estimate. An estimate of the settlement charges you are likely to incur. It also contains other information about the loan. Government recording and transfer charges. Fees for legally recording your deed and mortgage. These fees may be paid by you or by the seller, depending upon the terms of the sales agreement. Home inspection. An inspection of the mechanical, electrical, and structural aspects of your home. You will pay a fee for this inspection, and the inspector will provide you a written report evaluating the condition of the home. Homeowners insurance, or home hazard insurance. An insurance policy that protects your home and your possessions inside from serious loss, such as theft or fire. This insurance is usually required by all lenders to protect their investment and must be obtained before closing on your loan. Closing disclosure statement. A statement that itemizes the services provided to you and the fees charged for those services. You must be provided with your closing disclosure statement at least 3 days prior to your settlement. Interest. A fee charged by the lender for the use of its money. Interest rate. The charge by the lender for borrowing money expressed as a percentage. Lender inspection fees. This charge covers inspections, often of newly constructed housing, made by employees of your lender or by an outside inspector. Loan to value, LTV ratio. A percentage calculated by dividing the amount to be borrowed by the price or appraised value of the home to be purchased, whichever is less. The loan to value ratio is used to qualify borrowers for a mortgage, and the higher the LTV, the tighter the qualification guidelines for certain mortgage programs become. Low loan-to-value ratios are considered below 80% and carry lower rates since borrowers are lower risk. Mortgage. The transfer of an interest in property to a lender as a security for a debt. This interest may be transferred with a deed of trust in some states. Origination fee. A fee charged to the borrower by the loan originator for making a mortgage loan. Origination services. Any service involved in the creation of a mortgage loan, including but not limited to the taking of the loan application, loan processing, and the underwriting and funding of loans, and the processing and administrative services required to perform these functions. Payment shock. a scenario in which monthly mortgage payments on an adjustable rate mortgage, ARM, rise so high that the borrower may not be able to afford the payments. PITI, principal, interest, taxes, and insurance. The four elements of a monthly mortgage payment. Payments of principal and interest go directly towards repaying the loan, while the portion that covers taxes and insurance goes into an escrow account to cover the fees when they are due. Pest inspection. An inspection for termites or other pest infestations of your home. This inspection is frequently required by your lender. Points. Amount of money paid to reduce the interest rate on a loan. A point is usually equal to 1% of the loan amount. Prepaid items. Lenders often require the prepayment of items such as insurance premiums for private mortgage insurance, homeowners insurance, and real estate taxes. Prepayment penalty. A fee charged if the mortgage loan is paid before the scheduled due date. Private mortgage insurance, PMI. Insurance that protects your lender if you default on your loan. With conventional loans, mortgage insurance is usually required if you do not make a down payment of at least 20% of your home's appraised value. Your lender may require payment of your first year's mortgage insurance premium or a lump sum premium that covers the life of the loan in advance at settlement. The same insurance protection on an FHA loan is called Mortgage Insurance Premium, MIP. Recording and transfer charges. These charges include fees paid to the local government for filing official records of a real estate transaction. Sales agreement. The contract signed by a buyer and the seller stating the terms and conditions under which a property will be sold. It may also be called an agreement of sale or purchase contract. Settlement. The time at which the property is formally sold and transferred from the seller to the buyer. It is at this time that the borrower takes on the loan obligation, pays all closing costs, and receives title from the seller. Settlement costs or closing costs. The customary costs above and beyond the sales price of the property that must be paid to cover the transfer of ownership at closing. These costs generally vary by geographic location and are typically detailed to the borrower at the time the loan estimate is given. Settlement costs or closing costs. The customary costs above and beyond the sales price of the property that must be paid to cover the transfer of ownership at closing. These costs generally vary by geographic location and are typically detailed to the borrower at the time the GFE is given. Survey fee. A fee for obtaining a drawing of your property showing the location of the lot, any structures, and any encroachments. The survey fee is usually paid by the borrower. Title service fees. Title service fees include charges for title search and title insurance if required. This fee also includes the services of a title or settlement agent. Title insurance. Insurance that protects your lender against any title dispute that may arise over your property. Through a title search, the lender verifies who the actual property owners are and whether the property is free of liens. The title search company then issues title insurance, which protects the title of the property against any unpaid mortgages and judgments. In case a claim is made against the property, the title insurance provides legal protection and pays for court fees and related costs. You may also purchase owner's title insurance, which protects you as the homeowner. Tax certificate. Official proof of payment of taxes due provided at the time of transfer of property title by the state or local government. Tax service fee. This fee covers the cost of your lender engaging a third party to monitor and handle the payment of your property tax bills. This is done to ensure that your tax payments are made on time and to prevent tax liens from occurring. Tolerance category. The maximum amount by which the charges for a category or categories of settlement cost may exceed the amount of the estimate for such category or categories on a good faith estimate. When the originator selects and identifies the provider of services, these charges may only increase 10% in the aggregate. If the borrower selects a provider that is not on the written list provided by the loan originator, the lender is not subject to any tolerance restrictions for that service. Types of mortgage loan products. Adjustable rate mortgage, ARM. A mortgage loan or deed of trust, which allows the lender to periodically adjust the interest rate in accordance with a specified index. Balloon mortgage. A balloon payment is due on a mortgage that usually offers a low monthly payment for an initial period of time. After that period of time elapses, the balance must be paid by the borrower or the amount must be refinanced. The large sum payable at the end of the loan term is called the balloon payment. Construction loan. A short-term interim loan for financing the cost of construction. The lender advances funds to the builder at periodic intervals as work progresses. Conventional loan. A private sector loan which is not guaranteed or insured by the U.S. government. Fixed rate mortgage. A mortgage with an interest rate that does not change over the life of the loan, and as a result, monthly payments for principal and interest do not change. Hybrid ARMs. These loans are a mix or a hybrid of a fixed rate period and an adjustable rate period. For example, a 3-1 ARM will have a fixed interest rate for the first 3 years, and then will adjust annually until the loan is paid off. The first number tells you how long the fixed interest rate period will be, and the second number tells you how often it will adjust after the initial period. Interest-only ARMs. An interest-only IO ARM payment plan allows you to pay only the interest for a specific number of years, typically between 3 and 10 years. This allows you to have smaller payments for a period of time. After that, your monthly payments will increase, even if the interest rate stays the same, because you must start paying back the principal as well as the interest each month. Chapter 13. How to instantly increase the value of your multifamily home. We have spoken about the benefits of investing in a multifamily home and living in one of the units. But before we go on, you need to understand the difference between a residential property and a commercial property. Commercial versus residential, and why it matters. There is a major difference between commercial and residential properties. The distinction is generally related to the amount of units a property has. 4 units are considered a residential property. 5 units and above are considered commercial property. These distinctions are very important to keep in mind. Commercial appraisals are much more expensive and take longer than a residential property. Commercial properties are valued strictly based on their income and expenses. Residential properties are valued based on comparable homes that have sold in the general area within the past 6 months. Your opportunity to raise the value of your property and equity, or wealth. When you own a single-family home, the value of that home is based on homes that have sold just like it within the past 6 months. You can update your property and make sure that it has curb appeal, but there are no other ways to change the value of your home. However, as an owner of a multifamily home, part of the value of property is based on the net income after expenses, so you can control the value of your property. Ways to generate more income and value and reducing expenses. You can raise rents annually, but make sure you are at or slightly below competitors in your area. Most tenants expect rent increases. You can charge a percentage of the water bill to each unit. You can put in separate gas and electric meters so each tenant pays their own utility bill. If you have garages on the property, you can rent them out. You can install storage and/or coin-operated washer-dryers. Chapter 14. Why ugly is the new beautiful. The big secret many lenders won't share with you. One of the best opportunities in the real estate market is purchasing a home that is in need of updates or renovations. But many buyers and agents avoid these homes and instead often get into price wars with pretty properties. I'm sure you've heard that real estate is always about location, 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 right? The formula for creating wealth is finding the property that needs renovation that is in a great location. These properties may have just been neglected by the current owners. They could be a home that was foreclosed on. You may also find a home that is in great shape, but just needs some serious updating, since it may have been last updated in 1970 or 1980. The condition of these properties generally require that they be offered for sale at a price well below other homes in the neighborhood. That is your opportunity to purchase these properties, make the renovations, and bring them up to the neighborhood standards. That is truly the way to create instant equity and wealth. I recently helped a client who purchased a 4-unit property. The property was owned by a bank since the previous owner had not been able to make their payments and were foreclosed on. The neighborhood was great and in very high demand. The only property that wasn't selling was this ugly duckling. Homes in the neighborhood were selling for $300,000, and this home was priced at $194,000 and needed about $50,000 in renovations and repairs. Let's take a look at the numbers here. After repair value, $300,000. Purchase price, $194,000. Renovations, $50,000. Equity of $56,000 after repairs and renovations are completed. My client purchased this property and walked in the door with $56,000 in equity after he makes those repairs and renovations. The units in this property were rented way below market rents because of the current condition. Once he completes the renovations and repairs, each unit will rent for about $400 more each month than current rents. That equates to an additional $1,200 a month on the 3 units he will be renting in this 4-unit building. There are programs that allow you to purchase these properties and finance all of the renovation costs all in one single loan with attractive rates. The FHA program is called a 203K renovation loan. Fannie Mae also offers a conventional program called the Fannie Mae Homestyle Loan for this purpose. These programs are ones you should consider when you are searching for homes in your market. Always keep in mind, ugly is the new beautiful in real estate.